between excessive credit growth and deteriorating asset quality. Fitch Ratings says there's no reason to worry where China's concerned. Joining us to elaborate on this is the Fitch Ratings Associate Director, Vincent Ho. Vincent, walk us through your thinking here.
Well, I think, high economic growth in China, I think in the medium term, it's going to be sustained still. Although next year, we expect, there would be an economic slowdown, mainly due to the tightening, monetary condition. So I think this moment, the credit ratings of China remain as is. I think it's quite reasonable.
Okay, your stable outlook as far as to China goes. What about looking here and turning negative, given what you've been talking about in the latest report about the worsening of credit quality and the worsening of asset quality as well held by banks?
Well, that's one of the biggest concern on China's sovereign credit worthiness. And, the banking system of China is big, over, 100%, 150% of GDP. And, that could turn out to be, a sizable contingent sovereign liability. But playing devil's advocate, I'd say, with the reserve ratios that they have in place at the moment, it's probably quite, it would take quite something to have a run on these banks. Yeah, but in terms of the FX reserves, that part were equivalent to, 50% of GDP. And we are talking about, the asset size of the banking system is over 150%. So, there's still a gap between them.
Okay. Now, you're also concerned about the level of non-performing loans out there as well, saying that they are being masked. How?
Well, when you look at the NPL ratio, it has been declining. But, we think, number one, it's because of a sizable credit growth last year. And I think this year, although it's going to be slower, and also next year. But the second point is the new loan cover or reduce, part of the NPLs. And that could, So
it's not sorting out the symptoms of the problem, it's just covering them up by calling it new lending.
Yeah, and also not all of the loans, have been made, based on market decisions. So we are a bit concerned about this part.
Okay, well, a lot of loans were made with markets in mind, in a market-friendly environment, if you like. We're in the subprime crisis, or what led up to the subprime crisis, so perhaps that's not something we should be using as a yardstick.
Yeah, that is why we are more worried about it. When you check back the history, say last year, I think late last year, the Chinese government already came out to the market and asked the banks not to lend to some sectors that are of overcapacity. So I think, that raised some of the flags to the market. Something must go wrong.
Vincent, no downgrade in the future, though, in the short term?
I don't think so, as long as, the economic growth is to continue.
Which it should do, really should do, Vincent, at the end of the day, unless we have something cataclysmic go around with the world economy. Thank you very much indeed, Vincent.
Thank you.
Vincent Ho there from Fitch Ratings.